Hello friends, welcome to Nirmal Bang. I'm Piyush Jain and today we are going to be discussing about markets, about asset classes, about what's happening. Recently we saw the CPI, the consumer price inflation numbers inching back to 5%, IIP numbers, which is a barometer of industrial growth, that actually has depicted strong growth numbers. Of late, market has been wishing that perhaps some rate cut, no rate hike, that sort of messaging starts coming from RBI. So let's try and understand what are the macro numbers telling us, and how is the second half perhaps looking from the perspective of investment strategy. And for that, now let me welcome an industry veteran, Ms. Lakshmi Iyer, the CEO, Investment and Strategy at Kotak Alternate Asset Managers. Lakshmi ma'am, welcome to the show.
Thank you so much, Piyush. Happy to be here again.
So let's start first with the numbers here, the macro numbers. Uh, were you pleasantly surprised with the CPI numbers? And I recall the last time you were telling that perhaps almost the June, July numbers, those were largely because of vegetable prices. That's why the CPI went up. And the recent numbers were showing that there is a 16% month on month decline in the vegetable inflation. So CPI coming back to 5%, is that something which is now looking good?
Certainly, Piyush, I think this was in line with our expectation that there is going to be a cool off in the vegetable prices. Even the next month inflation probably could be on the similar downward trajectory. And I think the cyclicality is what is something that we are seeing as an easing point as we speak. So it's good news from a macro perspective, not great news, but good definitely. So we have to rejoice small victories.
So with the core inflation around 4.5%, when I look at the RBI comfort zone and what I'm hearing from you, does it imply that now RBI has no reasons to worry, even if Fed decides to do another hike, status quo or another hike, we don't know right now. But now RBI and the RBI committee will be relaxed. They don't need to really think about rate hike. What's the view from your side?
See, we were anticipating these numbers. Certainly, even RBI was anticipating these, or close about in these region numbers as they were presenting the policy. And we need to keep in mind that RBI's goalpost is 4%, and five is still, higher than 4%. So I think that's where we are right now. There is no reason for paranoia, but there is reason to be mindful and track not just. The vegetable prices, but crude oil prices, where we as a nation are price takers. And of course, as you rightly alluded to, what is going to be the US decision? It is not a slam dunk that there is going to be a rate hike. In fact, I won't be surprised if they decide to be on hold as well. But I think some of these are evolving situations, both from a domestic macro perspective, which seems to be well within our ambit of control, and of course the global macro, which is the bigger piece right now.
As an adroit investment strategist, as an expert, what do you make out when you actually take sort of look at very robust growth numbers? IIP 10%. Within that, it's a very well spread out growth across manufacturing, capex, mining, electricity, like very very well spread out. Almost 70% actually are into green. When you actually take a look at the tax collection numbers, robust, GST numbers looking very good, trade growth stable. What do you make out? What type of sort of investment climate we are in?
I think we are in a conducive investment climate. If I were to say, I say this quite often, that if the world is a desert, India seems to be an oasis in that. And clearly, all the check the boxes are seemingly aligned in our favor. If you look at the entities within the corporate pack which are contributing to earnings, and obviously, therefore, to the growth, I think those growth drivers are also intact. I posted a pic on Twitter, which talks about how EM growth is actually standing tall as per the IMF projections. So I think all those things, materials blended into one jar, gives you an interesting recipe of the next decade, kind of aligning stars in favor of India. Near term pit stops obviously something which we need to watch out for as investors. I think that's something which is par for the course.
Right, and and I was asking you all these questions because when we go down to asset classes, and there are so many options. We're talking about debt as an asset class, short term, long term. We're talking about sort of gold, silver. We're talking about equity as an asset class. Uh, Let me actually talk to you about debt, for which we know you since such a long time. On the debt, like what's the opinion right now? Is a short term debt which perhaps could outperform? How's the overall debt looking to you, and also where is the bias right now?
Currently, I think the mood is a little bit mixed, given that we are seeing a series of uh, starting off with the inflation front. Second is the crude oil prices going up. Third is the RBI policy alluding to possibilities of open market bond sales. All of that clearly are colliding to ensure that the bond yields are staying elevated. So that's number one. And that's our view also, that given that rate cuts in the US are going to be some time, in distance, it looks like even the narrative in India seemingly is higher for longer. So we are plateauing out in terms of interest rates, moving in a groove incrementally, which will react to, I would say, global macro and specifically crude oil prices. But as yields start inching up, which is where the phase we are in right now, I think it calls for a case for a good staggered deployment. If you are looking to create or construct a well-rounded fixed income portfolio, basis your asset allocation at this juncture. It's very difficult to give you the timing call right, but I think we are at 7.32 to 7.35 thereabouts on the 10-year benchmark. I think it's graded upwards another 5-10 basis points. It's good to start deploying your monies.
Right, and that should be a good time towards deploying in corporate bonds, like where perhaps is a slightly more alpha right now, like for our viewers, common investors.
So if you look at the nature of the government bond curve, it is completely flat. So the gap is hardly 0.15 to 0.2%, which is a flat yield curve as we call. So if you are deploying money in a government bond, you are better off being in the center, which is the belly of the yield curve as we call, somewhere in the closer maybe to the 5 year kind of a segment, rather than just being in 3 years. Our view is that the incremental delta of possible money making actually lies if you go down the credit curve. And as you are tracking, say, the BFSI sector, you will be aware that the NPA cycle in India banking sector is at a 7 to 8 year low. It's at about 1 odd percent. That's the time to really add on some credit risk in your fixed income portfolio, whether you like it through direct bonds, whether you like it through the private credit funds on the AIF platform, depending on what's your risk appetite. But I think it's time to add some credit flavor in your portfolio and live it for the next 3 to 4 years.
Well, that's something very useful, and that could be something which could create alpha. Apart from that, what's your own sense on the equities, on the sort of September quarter earnings, if you have been able to actually start seeing the initial flavor? But broadly, what are you expecting from the markets from a very top view perspective?
So, a couple of things. One is, I just came back from my roadshows outside of India, in the Middle East, in the Far East, and of course in the US. And the one narrative is India expensive? There is no denying that. But the counter to that is, as an investor, you will enter India expensive and you will exit India also expensive. So, I think that needs to be borne in mind. Second is, our house view on equities at the current juncture is neutral. Having said that, we believe that there has been pockets of valuation. Say, if you look at market capitalization between the large and mid cap, we have seen a massive shrink in terms of valuations, creating a slightly more preference for large cap in the near term over the mid caps. But if I take this story to a slightly longer period, consolidation and corrections, as we are seeing, stock specific, we believe are great entry opportunities, because rest of the world is struggling to grow at 2.5. We are growing three times that at 6.5. Even a country like China, which is the closest next, is struggling to grow at 5% because of the reasons we're all aware, specifically the real estate. So I think keep that in mind when you are allocating money to equities. Earnings will come, earnings will go. It's Q2 now, it's Q3 and Q4 next. It's always going to be a mixed bag. IT sector has not really given that kind of guidance yet that the street is looking out for. Some other sectors, say like auto or BFSI, might kick it in. But the point is that you need to think beyond these quarters and build your portfolio from a longish perspective. I think you need to have faith in the broader narrative of India. As I said, despite all the speed breakers that may come along, and we anticipate some of those speed breakers to manifest over the next couple of quarters.
And we'll close with our last question, and that would be what would be your advice to our viewers on the asset allocation right now across all asset classes, which you're seeing, like how much a range of into equities or debt, if you could say so, or any other asset class also?
So clearly, Piyush, near term, the risk reward is favoring, given the elevated nature of the yields, the risk reward is favoring allocation to fixed income as yields are elevated, not just in India, across the world. In fact, if you are looking to diversify outside of India, US yields, north of 4.8 to 4.9, give a great opportunity for you to participate in, a high yield, the mother of all economy asset class, and of course get some cushion or a hedge mechanism on the currency. So I think that apart, but if you are creating and you are not the tactical sort of an investor, and if you are saying that I'm the longer and longer stay kind of an investor, then I think stagger your investments over the next couple of quarters into equities and run with it for the next 3 to 5 years. Have tail-ended allocations to fixed income, and I think there is no cookie-cutter approach. You are aware, but your growth mindset or stability mindset should actually derive your next level of asset allocation.
Well, we'll take those words of wisdom for asset allocation, but for now, we'll leave it at that. Thanks a lot for gracing our show and giving us all the insights.
Thank you. Take care. Bye.
And dear viewers, with that, we wrap up the show. Hope you enjoyed it.
Subscribe to our YouTube channel and click on the bell icon to never miss an update from Nirmal Bang.